welcome to a brand new episode of Smart Money. Now, the market has done well for itself. In fact, we closed above the 22,000 level on the index this week. And the big question we're asking is the pullback that we saw, or is the volatility behind us? We have a couple of big cues to watch out for, which is, of course, the upcoming elections in the next few months, as well as the earnings season, which is now behind us. Our guest today is Gautam Dugat. He's the head research institutional equities at Motilal Oswal Financial. He's been tracking the markets for over decades now. So we're going to find out how you should wade through this volatility. Gautam, thank you so much for joining me on Smart Money.
Thank you.
Well, the next big trigger for the market, right, will be the general elections in a few months from now.
Yeah.
And I think the mood is of the NDA government coming back to power for the third straight time. You have observed many elections in the past. This time, what is your expectation as per the pre-poll surveys?
So, Sonia, thanks for inviting me. I think as far as politics is concerned, it's always difficult to predict. But if you go by the surveys which have come in, I think last week there were two big surveys which have come in. One was from Times Now, I think, and one was from India Today. So, two pretty big pre-poll surveys which have come in. Both of them have predicted somewhere about 330 to 360, which is well above the majority mark for the NDA. Post the December round of state elections, I think market has anyways been discounting the possibility of political continuity, which is basically for the third consecutive time, we are having a majority government led by a single party. Now, this has not happened for ages. The last time you had a single party majority government under the same prime minister, I think was in early 60s during the first prime minister's regime. So if that were to happen, it will definitely be unprecedented, because when the first time you saw full majority coming in 2014, it happened after almost, you can say, 30 years that we had a, single party rule, because the 30 years we had a coalition era, almost 30 years. So if you go by the current mood, if you go by the trends which are coming in from different polling agencies, it does suggest that there is going to be a political continuity, which augurs well for market, because it obviously helps you in driving the policy. Policy momentum continues. There's no disruption in that sense. And obviously, that is what market, I think, has been liking. You saw December, after the first round, after that state election round in the first week of December, you've seen almost 8% rally happening in market. Right, and that also led to a sharp swing in the FII inflows. You saw $8 billion coming in just in the month of December. Obviously, you saw some outflows in January. And I think if you combine that with the macro and micro tailwinds, I think the overall structure of the market looks quite decent from that point of view.
But don't you think to a certain extent some amount of this good news is already in the price, and maybe the FI money that had to come in already has? Because, we've seen the market run up so much in anticipation of the fact that after the state elections, I think a lot of people expect the general elections to play out in favor of the NDA government. So don't you think a lot of it is in the price?
Some of it definitely is in the price. But today you have to look at flows as a percentage of market cap. Very little has come in actually. Last year, you've seen some amount of money come in, I think about $22 billion, that is CY23. But prior to that, in CY22, you had seen almost $17, $18 billion of outflows from FIIs. So if you add up CY22 plus CY23, you've hardly seen $5 billion of inflows. Very few markets globally currently are as attractively poised as India, whether it is on macro front or micro front. If you look at macro, you're growing at 7% plus, give or take 10-20 basis points. Your inflation trends are moderating. Your current account deficit is in control. Crude prices are behaving. 10-year GSEC yield is in a nice range, and currency is stable. And then you add to that, the corporate earnings have been quite resilient. So very few markets today in India, in the global scheme of things, are offering such a strong confluence of macro and micro. And then if you add policy and political continuity to it, then India becomes a very attractive market. I think we've not seen any flows yet as far as FIs are concerned. And forget that. I mean, our market has moved away from those days where market was completely dependent on the direction of FI flows. If you look at the similar 2-year period between CY22 and CY23, you've seen almost $55 billion of inflows from domestic side. You saw 32 in CY22 and last year again $22 billion. And that continued in CY24. First month of CY24, you've already seen about $3.5 billion of inflows from domestic side. So that engine is on. Monthly $3 billion, $2.5–3 billion you're getting from the domestic side, all things put together. If you were to add up other instrument of flows, which is the Provident Fund, insurance, AIF, PMS, and other family office, and all of that put together, you're talking about almost a $3 billion per month kind of an inflow in India, just from domestic side.
Okay.
If you add up 25-30 billion dollar of FI flows, you're talking about 55 to 60 billion dollar of inflows in CY24. While the absolute number may look quite disproportionate, but as a percentage of free float market cap, it is hardly anything, right? So I think while some of it is already in the price, given the way earnings have shaped up, I think this momentum can continue. The only thing worrying right now is the broader end of the market, which is the mid caps and small caps. That looks quite extended in terms of valuation versus the underlying fundamentals.
You know, you said earnings, right? So that's the other big trigger for the market, the growth that we are seeing in terms of earnings. Earnings season is just behind us.
Yeah.
What are the big takeaways or the lessons that you've learned from this earnings season that you can perhaps base your next investment decision on?
So Sonia, if you look at the earnings which just concluded yesterday, if you look at a broad top-down view, we were expecting about 20% earnings growth for our coverage universe and 10 to 11% for Nifty. Actual number which came in was 30% for our coverage universe and 17% for Nifty. So at a very top-down level, earnings have been better than expectations. And many sectors participated this time. Auto, pharma, financials, within which PSU banks have beaten expectations again. You had very strong earnings coming from global commodities like metals and oil and gas. The only sector which disappointed to an extent was the low-end consumption, retail, EMS, and tech. But tech was in line with expectations, even though it was flattish. So you've got about 30% earnings growth if you look at our coverage universe of 250 stocks. Nifty, 17% growth. We were expecting just about 10%. And more importantly, if you look at the forward revisions, for Nifty at least it was quite stable. You know, we started the quarter at 975 for FY24. We've ended the quarter at 975 rupees of EPS for FY24 for Nifty. And for FY25 also, it is quite stable at about 1140. So we are still talking about a 20% plus earnings growth for full year FY24 and about 15 to 16% for FY25. What was a bit concerning was the earnings revision in the broader market X of Nifty. That is where the number of downgrades were almost 2x of the number of upgrades if you look at our coverage universe. That was the only sore point. Otherwise, earnings were quite resilient this quarter as well.
That's great to hear. Actually, earnings were better than expected as well overall. In the break, we were talking about the automobile sector, right? It's been one of the best performing sectors this week. And stocks like Bajaj Auto, TVS Motors are at fresh highs right now. Is it worth investing into them despite the rally that we've seen? And what's your big takeaway from earnings?
So Sonia, as far as auto is concerned, it has turned out to be once again the best performing sector, 5th or 6th quarter in a row, insofar as the earnings delivery is concerned. Going into the earnings season, we expected our auto coverage universe to do about 34-35% earnings growth. Actual number was 60%, led by Tata Motors, Maruti, Bajaj Auto. More importantly, if you look at the Nifty auto companies, there are 6 auto companies in Nifty. All 6 of them have either met expectations or a beaten expectation. Not a single company is disappointed. More importantly, auto in our entire coverage universe has seen the highest earnings upgrade. So we have seen our Nifty auto earnings upgraded by about 7%, right, between the preview and the review. As far as the next 12 or 24 months are concerned, I think large part of the big swing in the earnings is already in place in FY24. After staying flat for 5 years between FY18 to FY23, auto earnings has doubled in FY24. On this base, now we are expecting 10 to 15% earnings growth, which is still very strong. And second important point is your margin picture is still looking reasonably okay. While you have benefited a lot across sectors in FY24, FY24 was a year of a big margin recovery. This year you're getting top line growth hardly of 4 to 5%, but your earnings growth is somewhere about 30% for our entire coverage universe. While auto, the earnings growth was almost 100% for FY24. This may not obviously continue because you will now be catching up with the high base, but the sector still looks quite attractive. We are holding M&M in our model portfolio. We still have Ashok Leyland, and in the past we also had Craftsman in our model portfolio. Secondly, we've also published Hero as a top idea of the year for CY24 from our coverage universe. So that's the view as far as auto is concerned.
So on the EV side, I wanted your thoughts because, you know, all this latest news flow about Ola going ahead and sort of slashing their prices of their EVs. The entire EV pocket is not growing as fast as perhaps what one would have expected, especially EV two-wheelers. Now, in this space, names like TVS have done very well. The iQube has done exceptionally well, and that stock is at a fresh high. What do? You think the run is done here?
See, Sonia, it's always very difficult when the stock has tripled in the last 2.5 years. So possibly the stock may not go anywhere. It may remain sideways for next 6-12 months. We don't know how things will shape up in the short term. But the underlying earnings delivery has been very phenomenal, even for TVS. They've consistently delivered, I think, more than 10.5% EBITDA margins now for last 3-4 quarters. Plus their volumes have been quite solid, as you mentioned. As far as EV is concerned, while EV has a long road ahead, but I think both EV and ICE vehicles can coexist in the near to medium term. So I don't think market is necessarily driving derating of auto companies because of the threat of EV. Because the threat of EV or the potential of EV is now well discounted. Everybody knows about it for last 3-4 years. But despite of that, auto sector's fundamentals have remained very robust. Underlying earnings have been quite healthy. And the market cap creation has been humongous in the last 12-18 months as far as auto is concerned, whether you talk about a two-wheeler pack or a four-wheeler pack or even a CV pack. Barely any maybe 1 or 2 auto companies, if you keep aside, most of the auto companies have delivered excellent performance over the last 2.5 years.
Okay, so that's a strong case being built for the auto sector. But I also want to ask you about the banking space and your thoughts on the earnings and, of course, what to do with names like HDFC Bank. But more on that coming up after a very short commercial break. Don't go anywhere. We'll be back on Smart Money in just a bit.